Have you ever looked at your bank account and thought, okay, the number is the same as last year. Nothing changed. I didn't lose anything. But somehow, groceries cost more. Your rent went up. That vacation you planned 2 years ago now costs 20% more than what you budgeted. So what's going on? You didn't spend more. You didn't make bad decisions, but your money is buying less than it used to. That feeling? That's not in your head. That's inflation doing exactly what it's designed to do. Quietly, slowly, eroding the value of every single dollar you have sitting in that savings account. And here's the scary part. Most people don't realize it's happening until it's too late.
They think saving money is enough. They think keeping cash is safe. But in an inflationary environment, doing nothing is actually a decision, and it's usually the wrong one. So in this video, I'm going to break down exactly what inflation is, how it actually affects your money in ways most people never talk about, and most importantly, what you can actually do about it. We'll look at real numbers, real strategies, and I'll show you which options make the most sense depending on where you are in your financial journey. Please give me 10 minutes, and I'll give you clarity that most people take years to figure out on their own.
Welcome to Martech Finance, where we explain investing concepts in a simple way. But first, a quick disclaimer. This video is not financial advice. Everything I share here is for educational purposes only. Always do your own research or speak with a qualified financial advisor before making any investment decisions. All right, let's get into it. Before we talk about how to protect yourself, we need to make sure we're both talking about the same thing. Because inflation is one of those words that gets thrown around constantly, but most people have a fuzzy understanding of what it actually does. So let's clear that up right now.
Inflation is not just prices are high. That's the cost of living. Inflation is specifically about the rate at which prices are rising over time. And as prices rise, the purchasing power of your money falls. Here's a simple way to think about it. Imagine you have a jar with 100 coins in it. Each coin can buy you 1 apple. Today, you have 100 apples worth of purchasing power. Now imagine next year. Each apple costs 1.10 coins instead of 1. You still have the same 100 coins, but now you can only buy about 90 apples. Nothing was taken from you. No one stole anything. But you lost 10 apples worth of value just by doing nothing. That's inflation. Your money didn't shrink on paper.
But its real value, what it can actually buy, absolutely did. And here's the number that should wake you up. The long-term average inflation rate in the United States has historically been around 3% per year. That might sound small, but at 3% per year, prices double roughly every 24 years. That means something that costs $100 today will cost around $200 in 2049. If your savings aren't growing at least at the rate of inflation, you are losing ground every single year, even if your account balance looks the same. Now that we understand what inflation is, let's talk about the 4 specific ways it hits your finances, because most people only see one of them. The first one is the savings account trap. This is the big one. Most people keep their money in a regular savings account and feel safe. And I get it. It feels responsible. You're not gambling, you're not taking risks. The money is right there. But here's the catch. The average traditional savings account in the US pays somewhere around 0.5% interest per year. Some pay even less. Meanwhile, inflation has been running at 3%, 4%, even higher in recent years. Do that math. If your savings account earns 0.5%, but inflation is at 3.5%, your real return is negative 3% every single year. You are losing purchasing power while watching your balance slowly go up.
It's one of the cruelest financial illusions out there. Now, high-yield savings accounts are better. Some offer 4% to 5% in today's rate environment. But that rate changes. It follows the central bank's policy rate. When rates go down, so does your yield. The second way is cash losing value over time. I know people who keep significant amounts of cash, either at home or just sitting in a checking account, because they feel it's safe. And I understand the logic. Cash is liquid, it's accessible, no risk of market crashes. But cash is actually one of the worst stores of value in an inflationary environment. Think about this.
If you kept $10,000 under your mattress in 2000, that $10,000 in 2024 would have the purchasing power of roughly $5,500 in year $2,000. You literally lost almost half your real wealth without spending a single cent, just by holding cash. The third way is fixed income getting squeezed. This one affects a lot of people who think they're being conservative. If you're living on a fixed salary that doesn't adjust for inflation, your real income is shrinking every year. Same paycheck, less purchasing power. This is also why retirees on fixed pensions can struggle over time. The pension payment stays the same, but groceries, healthcare, utilities, they all keep going up. And the fourth way is how debt dynamics flip, but not always in your favor. Here's an interesting nuance most people miss. If you have fixed-rate debt, like a fixed-rate mortgage, inflation can actually help you. Over time, you're paying back that loan with money that's worth less than when you borrowed it. The real value of your debt shrinks. But if you have variable rate debt, like a credit card or adjustable rate loan, inflation usually leads to rising interest rates, which makes your debt more expensive. So it really depends on what kind of debt you carry. Now, let me show you the real cost of doing nothing with two people. Meet Sarah and Marcus. Both are 30 years old. Both have $20,000 to put away for the future. Both are careful, responsible people who don't want to take unnecessary risks. Sarah keeps her $20,000 in a traditional savings account, earning 0.5% per year. She feels good about this. The money is safe, she can access it anytime. Over 30 years, at 0.5% compounded annually, Sarah ends up with about $23,200. Looks like a gain, right? But here's the reality. With average inflation at 3% per year over that same period, the purchasing power of $20,000 in today's money would need to grow to roughly $48,500 just to maintain its real value. Sarah has $23,200, but in real terms, she's lost nearly half her purchasing power. She played it safe.
And she still lost. Now meet Marcus. Marcus puts his $20,000 into a diversified investment, a simple, low-cost index fund tracking the S&P 500, which has historically returned an average of about 10% per year before inflation. Over 30 years, Marcus ends up with approximately $349,000. Even after accounting for inflation, his real purchasing power has grown dramatically. Same starting point, same 30 years, completely different outcomes. Not because Marcus took reckless risks, but because he understood one simple truth. Doing nothing with your money is not neutral. In an inflationary world, standing still means falling behind. Now, I want to be clear. The stock market goes up and down.
Past performance is not a guarantee of future results, but the principle stands. Assets that historically outpace inflation protect your wealth. Cash and low-yield savings over the long term do not. All right, now we get to the part you've been waiting for. What can you actually do? Here are 4 concrete strategies, from conservative to more growth-oriented. The first strategy is high-yield savings accounts and money market funds. This is your starting point. If you're keeping cash for emergencies, which you should, typically 3 to 6 months of living expenses, make sure it's in a high-yield savings account or a money market fund.
In today's environment, you can find rates of 4% to 5%. That won't beat inflation over the long run, but it significantly reduces the gap. This is not a wealth building strategy. This is a wealth preservation strategy for your short-term cash. Keep your emergency fund here. Don't keep your long-term savings here. The second strategy is Treasury Inflation Protected Securities, or TIPS. These are government bonds specifically designed to protect against inflation. The principal value of a TIPS adjusts with the Consumer Price Index. So if inflation goes up, your bond's value goes up with it.
They are low risk, backed by the US government, and they're specifically built for exactly this problem. The trade-off is that the returns aren't going to make you rich, but for a conservative investor who wants to protect the real value of their savings without taking equity risk, TIPS are a solid tool. The third strategy is equities, specifically broad market index funds. Historically, equities have been the most reliable hedge against inflation over the long term. Companies can raise their prices when costs go up, their revenues grow with inflation, and over time, that growth gets reflected in stock prices.
The S&P 500 over the past century has averaged around 10% annual returns, well above the historical inflation rate of 3%. That 7% real return is essentially the reward for staying invested through the ups and downs. This is the strategy that makes the most sense for long-term goals: retirement, generational wealth, financial independence. It requires patience and the ability to stomach short-term volatility, but over 10, 20, 30 years, the data is very consistent. Equities win against inflation. And the fourth strategy is real assets, real estate and commodities. Real estate is one of the oldest inflation hedges in history. Property values and rental income tend to rise with inflation.
If you own property, your asset appreciates in nominal terms, while your fixed-rate mortgage stays the same, a double benefit. Commodities like gold and oil also tend to perform well during inflationary periods because they represent real, physical things with intrinsic demand. Gold in particular has been used as a store of value for thousands of years, precisely because it can't be printed by a central bank. That said, real estate requires significant capital and carries its own risks, and commodities can be volatile. These are tools for a diversified portfolio, not a one-size-fits-all solution. So let's bring this all together. Inflation is not an abstract economic concept.
It is a direct, constant threat to the real value of your money. And the biggest mistake most people make is thinking that keeping their savings in cash or a basic savings account is the safe choice. In the short term, it feels safe. Over 10, 20, 30 years, it's actually one of the riskiest things you can do with your wealth. The antidote is not complicated. Keep your emergency fund in a high-yield account. Consider TIPS if you want conservative inflation protection. Invest your long-term savings in diversified equities. A simple, low-cost index fund is more than enough for most people. And if real estate fits your situation and goals, it's a historically reliable inflation hedge. You don't need to be a financial genius. You don't need to time the market perfectly. You just need to understand one fundamental principle. Your money needs to work at least as hard as inflation does. If it doesn't, you're losing the race, quietly, slowly, every single year. And now you know why. And more importantly, you know what to do about it. That's everything I wanted to cover in this video. I hope it gave you a clear, practical picture of how inflation works and how to actually protect yourself from it. If you found this helpful, I would really appreciate it if you liked the video and subscribed to the channel. It genuinely helps this community grow. And if you want to go deeper, I'll leave a video right here on exactly how index funds work and why they're such a powerful tool for long-term investors. I think you'll like it a lot. Thanks for watching. See you very soon.